Hello, everyone. This is Mike Eklund and Colton Tickle with Financial Symmetry for our third quarter or October 2025 market update. Thanks for those of you joining us again. Once as a reminder, we prepare these recordings every quarter with just a quick 10-minute update of what occurred last quarter and some key market topics. As a reminder, this is not specific investment advice for your portfolio. If you have any specific questions on your investments, please contact your Financial Symmetry advisor. If you're not a client of Financial Symmetry and want to hear more how we can help, we'll have contact information at the end of the slide presentation to reach out to us. So with that, I'll hand over to Colton, who's going to talk a little bit about what happened last quarter in the markets.
Yeah, so just going straight into kind of the good stuff. Not only was it a strong quarter for the equity markets, but also fixed income, but also for the whole year, with emerging markets and international developed kind of leading the way for year-to-date returns. We typically don't really see it this strong returns across the whole markets, but it's great whenever they show up because staying diversified is one way to actually capture those returns.
Yeah, I think it's a testament to beginning of this year. Who would have thought that we've seen returns like that, especially what we saw in the spring? But it's always the old saying that you kind of have to stay in your seat if you want to realize the returns of the markets. Yeah, so the next slide is the really the topic of the day is government shutdowns. And we thought we'd kind of share this that kind of looks at historical government shutdowns and how the stock market has done during those time periods. Since 1981, this is the 11th shutdown the government has had. A lot of them are, as you see on the slide here, are very short, 1, 2, 3, 5 days. Obviously, this one is a little bit longer, as well as a few others. Some of the key takeaways here is historically the market has been up. If you look at the beginning of the shutdown and the end of the shutdown, which is probably surprising to some folks. And then, the reason why that typically happens is because the market is anticipating that there will be a resolution reached at some point. So obviously, no one wants the government shutdowns, but does not mean you need to change your investment strategy.
Yeah, this one kind of looks back at the largest 10 U.S. stocks by market cap throughout the years. So going all the way back to 1980 to current day. If you can see a clear line, I challenge you to see that because it is all over the place. Whenever I first look at this slide, I kind of think of the high school yearbook awards that you see. But who's likely to most succeed in the past or today doesn't mean that they're going to continue in the future. So thinking back to 1980 where IBM, AT&T, and Exxon were the largest, they're not even in the top 10 now. So just keeping that in mind, and again, why diversification matters. And instead of trying to guess who's going to be staying on the top, just focus on owning the whole broad mix of companies to be able to capture that return.
No, that's helpful, Colton. It reminds me, I started my career at General Electric, here back in 2000, and it was number 2 on the list, and everyone thought that you didn't need to buy a mutual fund or an index fund because GE was so diversified. And as you see on this list, it quickly, fell off in a few periods afterwards. So yes, the benefit of capitalism is the good companies of today will be replaced by, great companies of tomorrow. So this is always one of my favorite. Some call it the quilt slide for those that look at diversification and the benefit of owning just more than one area of the stock market. The focus here is really the S&P 500, which over the last 10 years has been a great performer. Over the last 10, as you see here on the slide, we look from 2015 to 2024. It has been the best place to invest within equity markets throughout the world. The interesting thing that I don't think a lot of people realize is over the last 25 years, if we look at the 10 different asset classes on this page, it actually was second to the worst. So although it's done well lately, in the 2000s, 2010 to 2014, it wasn't nearly as strong as some other areas in the market. A good example so far we're seeing in 2025. Many don't realize, but international small cap value is up over 40% this year. So if you just would have had your portfolio only invested in the S&P 500, you would have missed out on that, much larger return for international small cap value companies. So once again, we do think very highly of diversification. It's definitely your friend over the long term. You don't know where returns are going to come from in the future, so that's why it's benefit to own all of it.
Going into kind of a little bit more detail of those individual companies. it's kind of tempting to kind of look back and, just see which company, produced the highest returns and, think that that will continue going forward. But just a reminder to not drive through the rearview mirror. And this slide highlights that exactly. So if you look back at the last 10 years, you had a 35.7% chance of picking a outperforming stock. So about a third of the time, you could get lucky and pick something, pick a company that outperformed. But then if you look forward, going forward, you had the same exact chance at producing or picking a winner from that point. So just a reminder that past outperformers aren't the future performers. So again, reiterating the diversification factor there.
Yes, moving on to the next slide. They're not too big to fail. So really, this is a good example, similar to the previous slide. Not only with individual companies, you have the chance of underperforming the market, but you also have the chance where the company can go bankrupt and the stock price can go to zero. So a few examples on this page, such as WorldCom, Lehman Brothers, Silicon Valley Bank more recently. Enron is a name that gets popular from the early 2000s time period. So, once again, that we don't think it makes sense to try to bet on individual companies. And as the late founder of Jack Bogle once said, you don't look for the needle in the haystack, you just buy the haystack. And so that's, I think, is a much better approach, because we don't know who the next winners of the next 10 years are going to be and the losers. And the last thing you want to do is put all your money in a company that goes bankrupt. So
yeah, I think that's a good point. And what kind of highlights to here for me is just the kind of risk concentration that this would bring up, and just thinking about that. So again, keeping that in mind. So next slide is just across fixed income. I know it's not always the most interesting topic to talk about, but bond yields have been going up in the last few years, and with that, you can kind of expect a higher yield that you would actually get from moving your money from the bank or your fixed income allocation actually bringing you actually additional yield. That doesn't mean that you just go looking for the highest yield you see, because you got to be thoughtful about when you actually need the cash flow. So positioning your bond investments in a way that support your broader financial plan is the best way to kind of balance that income risk and stability.
no, that's great. I think this is a good example of, if you do have more cash than necessary in the bank, and let's say you have a payment for the kid's college or down payment on a house in 3 or 4 years, there's some other options that can kind of guarantee that return over that time period, and don't have the same amount of kind of, for example, reinvestment risk. So something to consider, to kind of reevaluate how much cash you're sitting on versus what the other alternatives are, and the potential return as well. And then finally, I think with every webinar that we do, we like to kind of summarize folks with our 3-step investment process. This is if you had interest to work with us or you're already working with us. The key thing is that we don't develop an investment plan until we create a financial plan based upon your goals. This could be when you're planning to retire, maybe the kids' college funds or other kind of large one-time expenses. Once we have that plan in place, then we develop an investment plan, and the percentage of how much is in stocks versus bonds really depends on when you need the money. So if the money is needed sooner, the next, let's say 5 to 7 years, we want it more conservatively invested, more high quality bonds. And then if it's not needed the next 5 to 7 years, we want to own companies or stocks for long-term growth to offset that cost or that risk of inflation. And then after that, obviously using low-cost ETFs and mutual funds that are tilted towards companies with higher expected return. And then finally, monitoring that plan, which I think a lot of people kind of miss that last part. And that would be rebalancing when opportunities present itself. Like for a lot of folks this spring with the tariff kind of market declines, was opportunities to buy at cheaper prices. So if you need more help on that, going back to the kind of how we wrap up here, on your existing portfolio and you work with Financial Symmetry, don't hesitate to reach out to your advisor. If you don't work with us and you want some additional help, we're happy to connect with you and see if we're a good fit. The last slide here has Colton and my contact information, and then our website at financialsymmetry.com. So with that, thank you very much for listening in this quarter, and look forward to speaking with you next quarter as well. Thank you.